Manoj Kumar Dubey, who is the CEO and Managing Director of Indian Railway Finance Corporation, who is speaking with us. Great having you, Mr. Dubey. Let me first contextualize this. We've got plenty of rate cuts which have come through. I know that your cost of funds is probably industry best. I'm trying to understand whether you get any benefit from a rate reduction or a rate cut, and how does that get passed on? Just explain how this plays out for you and your business and your customers.
So good morning, Hers. As you mentioned about the rate cuts, let's start with that. Before that, I must reiterate that we came out with very, very good numbers as we had given the guidance to the market in terms of our profit growing for the last three quarters in double digit. NIM improving continuously for the last 3 quarters in this new diversified mode that we launched last year for this FY. Yes, with the rate cuts, things are really hotting up, a little competitive, and which is good for the country. You know, for us as at IRFC, since we are looking forward to lending to government assets, this is a sweet point I can share with you for the fact that a lot of capex, in fact, more than 60 to 65% of the capex in the country is coming from the government entities. And those of ones who are doing really good as per their balance sheet, as per their cash flows, they deserve to be financed at a very competitive rates. Perhaps IRFC is doing the same now in the whole railway ecosystem. Banks are also competing with us for nearly 10 to 15 year time frame of infra projects also. But as you mentioned, having our inherent strength in low overhead cost as well as with our zero NPA status, we are still able to garner the borrowing at a cheaper rate even in the ECB market. And of course, we are also having a little relief from term loans that we are putting our mix from the bank side. So overall, it's a very good time for IRFC also along with other lenders to pitch in for the kind of infrastructure appetite that the country has going forward.
And what's the growth run rate you're clocking? You've already done 60,000 crore of disbursements. I know you guided for, or your target was 60,000 crore at the start of the year. You've already done it in 9 months. What's the AUM growth target going to be like for FY26? And what's the disbursement now in terms of the revised target looking like?
So has a little correction. 60,000 was the sanction of the assets that we have already achieved for the whole year guidance that were given in by the end of Q3 itself. Our disbursement target were 30,000 crore for the whole year. For the fact that we didn't have any kind of pipeline when we started at the beginning of the year. So that also is on track. We have already done more than 22,000 crore, and end of the FY, we believe that we'll be crossing this guidance for 30,000 crore marks also. AUM, yes, this year because disbursement picked up as we had mentioned in the last quarter, we ended up this quarter at 4.75 lakh crore, which is highest ever for the company. Going forward with more and more business coming in the kitty and now the pipeline is there in the place, we believe that every quarter our AUM will be showing a improvement going upward, and this trend is, we believe, that going to continue for at least 3 to 5 years without any break. So that is what guidance we are giving. Numbers we are not putting for the fact that we ourselves don't know exactly the kind of business that will be flowing to us. What we can assure you that for the fact that we are one of the most competitive lenders in the ecosystem, for the fact that we have got appetite for the big ticket projects also in the government ecosystem, there are a lot of queries to us, and the queries are all for the kind of assets which is more than 5,000 crore. So if we feel that they are fitting into our appraisal parameters where we are very, very particular about looking for an asset which fits in our model of zero NPA, if those are coming in big numbers, AUM is going to grow in a very steep manner. But overall also, whatever be the scenario, AUM for IRFC going forward will be growing every quarter. That is something we are very clear about.
And you're very efficient from an operating cost standpoint, and therefore that entire flow through should happen on profitability, whatever comes in terms of growth and margin accrual for you.
So, Harsh, yes, we intend to remain a strong B2B kind of lenders. In fact, January 1st, we unveiled our 5-year plan for lending in the manner that we are looking forward to nearly 20 customers. And we intend that in going forward in the next 5 years, every entity should be borrowing from our side in tune of nearly 15,000 crore. So what we are trying to really do is sticking to the cherry pick 20 customers in the government ecosystem who are having linkages with the railways. And we are looking forward to lending them in tune of 10 to 15,000 crore going forward in the next 5 years. With this methodology, we feel that we do not need to really put in a large number of employees or the new officers in our system. We leveraging the technology and leveraging the ERP, we believe that we are in a very sweet spot to maintain our very low overhead costs going forward. And whatever benefits comes out of it, we are very happy passing it on to the customers so that it's a win-win scenario. In fact, you know, at IRFC, since we are the prime lenders for government entities, we believe that we are aligned with the national goal of arranging raw material for any kind of infrastructure development, which is the borrowing. Borrowing is the single most prime raw material for any of the infrastructure projects, and here we believe to bring in efficiency by arranging lending at the very competitive rates. I think with this philosophy, IRFC is really placed in a very sweet spot, and we believe that there won't be any dearth of businesses for us going forward, with the ring fencing boundary of maintaining pristine assets with the zero NPA kind of futuristic goals.
Okay, and Mr. Dubey, hi, morning. This is Nehi joining in. Talk to us about your expansion outlook. You've said that you're aiming to expand into metro rail, renewable, logistics and ports. Talk to us about what kind of disbursement are you eyeing there, and how much could this contribute, these newer segments, how much could they contribute to your overall top line?
So yes, that's a very pertinent question for our futuristic plans. As you rightly mentioned, we have our interest into all these areas who are having direct linkages with the railways. So going forward, yes, again, on this calendar year beginning, we have set a target for ourselves that by 2030, our asset mix should be 60-40. Meaning thereby, the 60% of our assets should be cost plus model of Indian Railways, and another 40% should come out from the railway ecosystem having linkages. In fact, within that, yes, we are very actively looking forward to a solution of giving a domestic kind of funding to metro railways, urban transportation, which are again kind of nation building kind of projects where they also require a kind of very smart, efficient funding proposition. For the fact that it is mainly for the public at large, and any costly kind of funding will finally be bearing on the public at large. So we wish to pitch in. Why we are sweetly placed to pitch in? For the fact that again our overhead cost is low, and we are able to garner a kind of ECB loans as well as domestic loans at a very competitive rates, and we want to be partner in progress with them also. Yes, ports are something which are very important asset for us, and we are looking forward to them also. 3 to 4 government-owned ports, we are already in talk, and in their CapEx requirement, we are sure that we'll be pitching in with a very smart kind of lending rates that we are planning to give it to them. So overall, yes, we will be having our interest into the power value chain into Gencos and Transcos only. Discoms are not our business. Port connectivities, where there is a rail connectivity, yes, there will be part of our portfolios going forward. Metro rails, yes, they will be surely be our portfolios in going forward. And anything coming in the railway ecosystem for first mile, last mile connectivity, multimodal logistic parks, these are also going to be on portfolio going forward. So these are the kind of mix that we are looking forward to next 3 to 5 years.
Okay, and Mr. Dubey, also talk to us about what you're expecting to hear from the budget. It's just around the corner, about 10 days away. If you have any wish list or any expectations that you're expecting to hear in terms of the announcements from the budget?
So Sydney, what we understand from the discussion that is going on in the budget, number one, that railways capex requirement will remain more than 2.6 to 2.7 lakh crore. Not only for the coming FY, but also for next 5 to 10 years, with the kind of appetite they have in capacity augmentation, as well as having high-speed rail corridors for passengers and freight both. So going forward, this requirement of capex in this large number will remain intact for Indian Railways. Now, the question is, how much out of it is coming directly from the government budgetary support, and how much is coming for extra budgetary support either from lending from IRFC, because we remain the sole financing arm for the Indian Railways, as well as the PPP mode. We feel that either of the three mixes that is going to take place, IRFC will surely be having something to contribute in their capex plan. So be it PPP, be it direct funding through ourselves, we believe that the kind of appetite that Indian Railway has and the kind of requirement that various ministries has from the government of India, we believe that going forward there will surely something where we'll be directly or not directly but through PPP mode pitching in for the capex requirement of Indian Railways.
Thank you so much, Mr. Dubey, for coming in and speaking with us. It's been a pleasure to talk to you about Q3 and beyond.